So I thanks for that intro. I
You're welcome.
created this deck today, and it was from an inspiration of talking to one of my mentees last night about what he should do to grow his wealth. He's a very young person, and I was trying to explain the value of real estate investing and the value of cash flow investing. Um, and yes, we do have open investments if you guys are interested in discussing with us later. But I wanted to cover today why I invest for cash flow. And I'll start with, I'm gonna go all over the map. I'll bring it back full circle. But I'm gonna start with my introductions of myself, my background, my real estate journey. So I'm gonna get a little bit personal and talk about what I've done in the past. Not to say that's what I'll be doing in the future. Talk about residential versus commercial, cap rates, cash flow versus depreciation, deferrals and depreciation, and how it relates, and it all tied together. Deferred equity, senior living, and compound interest. A lot of different topics, but I will tie it together. So my name is Eng Taing, CEO, founder of Tozy Capital. I went to Wharton for economics, did investment banking, joined the Peace Corps, did a bunch of stints in corporate America, DirecTV, Riot Games, Apple, most recently. And I am also a syndicated and private fund manager with $100 million of assets under management, and have been personally investing throughout the whole time since my investment banking days. And I have learned a lot, and hopefully I can share some of that knowledge to you guys. So a little of my personal background. I was born in a refugee camp in Thailand. So I wanted to highlight that because I wasn't born with money, grew up pretty poor. And my parents were refugees from Cambodia. I grew up in LA, day traded my way through high school. This is when you have to go to a public library to get internet in the late 90s. And also when you could just pick any stock and make a lot of money. So it's kind of, it was very deceptive in terms of how much money I could make such an early age, having worked several jobs and saving that. But what I learned from that is learning patterns and data and learning math and stats. And I use that to then work for jobs at college and also play poker and day trade it again. Actually, most of my poker winnings helped pay for my college tuition. I was 2-time Wharton champion. And this is right when Texas Hold'em became very popular as well. Took a lot of my time. I did economics and investment banking, and I also then joined investment banking, and I helped cause the subprime mortgage crisis. Apologize for that. I booked $4 billion of pretty shitty debt. Now I know what is good debt and what's bad debt. And then after that, I joined Peace Corps, where I met my wife. Most people of that time just went to get an MBA. I decided to just go to Peace Corps. My investment timeline.
So real quick, Ang, I'm
Go
not
ahead.
sure if you're showing your screen, but we're not. We're only seeing the Tozy Capital.
Okay, so you should probably see a lot more.
Okay, well, no worries. I mean, your story fit well with just the Tozy Capital brand, so I just wanted to let you speak.
Okay,
There we go. There we go.
Do
A
you
little
see
bit
my
of
screen?
history. Yeah, I see a little bit of history.
Okay. Well, it's just what I just said. Hopefully, let me know if you guys aren't seeing different slides because I'm presenting multiple slides.
Perfect.
Do you see the slide? Really a lot of timeline.
Yes.
So I bought my first triplex in 2009. I remember clearly. It was $126,000. I put like $37,000 into it. I also remember that it was bought 3 years ago for $320,000. So I bought it on a foreclosure, but there were still tenants there. And when I bought it, I helped raise some of the equity by put some money into it by essentially repainting and putting some vinyl flooring. And that's what I've been doing ever since. I buy for cash flow. I add a little bit of value. I refinance within a few months or within a year. Take that cash out. I buy something else. during this time, by the way, I was in Peace Corps. So it's not like I was making a lot of money, making $20 a month. I bought and I kept buying, but I've always bought for cash flow. And in California, where I bought, you could buy for great returns back then. Since 2015, I found that it does not pay off to buy single family or residential size properties. Many other reasons as well, but especially in California. So my lessons learned were it pays off to have a support network where you invest. So that's why most people do try to figure out to invest in the backyards. I understand that. But if your backyard is in the Bay Area or in California in general, you probably should not invest in real estate. I should have probably bought more from 2009 to 2013. I should have optimized my capital. That's another thing hopefully you guys learn. If you guys have capital yielding 4%, 5%, then if you have the option to invest at a predictable 10, 12%, you should reallocate capital. That's really important to accelerate your growth. Another thing I learned is don't take 30-year fixed mortgages. You will almost always refinance as soon as you get more equity. Because remember, your capital, as you pay down the mortgage, is essentially earning an opportunity cost of 3%. If you refinance almost every 2-3 years, if it appreciates or if it doesn't, or as you pay down more of the capital, you are able to take capital that costs 3-4% and place into 7, 10, 12%. That's essentially arbitrage. And if you do it with some predictability, that's how you really accelerate your velocity capital. When you pay for 30-year fixed mortgage, you're paying for security and safety of future staticness. But what you should really be paying for is flexibility. And flexibility actually is cheaper. Flexibility to make optional decisions. That's what cash flow is. When you buy appreciation properties, it appreciates and is locked in. It does not cash flow. You essentially buy it to pay for its growth. When you buy for cash flow, you buy a tree that has many leaves and creates a forest. When you buy for appreciation, you buy a tree that becomes a bigger tree. It's a very single point of failure. Another thing I learned is having secondary passive income really helps you over mindset. I grew up with scarcity mindset. That's pretty common with most people growing up poor or growing up as a refugee or immigrant. When you have abundance mindset, when you have a safety net that is yours and secure, it really helps. It makes you make better career decisions. It makes you go to your boss and say more courageous and bold things. It allows you to move up in your career, and it allows you to use your money more wisely. And I'm not even talking about a lot of passive income. I'm talking about just a little bit. Having extra $1,000 a month, extra $1,500 a month, tax-free. Which is another thing I learned, that real estate rents are mostly tax-free. I have made a lot of money, and I probably have paid very little taxes on that money for real estate. For my W-2 jobs, I have paid a lot of taxes on it, but recently I have not. So thanks to real estate. Why not California? And someone asked why not in California, because it did not generate cash flow anymore. It's harder to find cash flow properties. It's harder to find good investments. It's also not landlord friendly. I am not necessarily Republican, but I love investing in Republican states. I love investing where I can evict a tenant. It's hard to evict now, of course, but in general, trying to evict somebody in state of California is a pain. And what I've also learned is residential loans are a pain in the ass. For those who buy a house or have a house, you probably know that. If you haven't, you will learn. And that buying one residential property at a time is not scalable. Because everything you should think about is, am I going to do this again and again and again? If I'm not, then why are you doing it? Are you doing it for a specific reason? If you're doing it for cash flow, the single family is not a place to do it. And it's probably just shouldn't be a place in general. Single family does have pros and cons. It's definitely more accessible. You can touch and feel it, although you can touch and feel a lot of things. But it is very volatile. It goes with sales comparable. Yes, and Travis, I understand you hate single family. We all hate single family. So my goals when it comes to investing in real estate is high cash flow, low maintenance. I talk about low maintenance as in scalable, tax advantage, and passive income. And most real estate is tax advantage, but not all of them. And I'll talk about that a little bit. And so what I've done since is I've started a real estate investment company. And the genesis of Tozy Capital is really, I've been talking about real estate. I've been talking about my returns on real estate. And my friends and colleagues have asked, can I invest with you? Can I invest with you? And so more recently, I have a lot of folks who co-invest with me. And that's essentially the genesis of what we do. We invest in strong out-of-state markets. And I have invested over $100 million, or I invested in $100 million in commercial assets. And last year, I've started to make more passive income than my full-time job income, which is why I left Apple recently. So that's financial freedom to me. I'm still hustling because this is fun, and I love making money, and I love helping my investors make money and securing my future.
So we got some questions here we could answer real quick. So Al Shah asks, I learned that several big giant software companies would like to move out of California. How will this impact renting business?
Rents are in the Bay Area aren't necessarily correlated to house prices. And if you've seen what houses are going for in the Bay Area, you see that it's probably going up. But you're also seeing rents go down by 10, 20%. Now, this is not normally what happens with housing and rents. Usually there's a strong correlation. But what affects prices is affordability. If financing goes cheaper, you can afford more. If the rates go down, your money goes farther. If your RSUs, your stocks go up, we can afford more. You're probably not getting a raise right now, or maybe a little bit of raise, but the stock markets have gone up significantly. Capital markets are going up. Asset markets are going up because there's tons of injection of liquidity into the capital markets, and the rates are so low on a savings yield that it disincentivizes people to save. If you put money in a bank, you're losing money. Just facts. That's inflationary factors. Inverted yield curves are happening across the world. So everyone's plowing the money into assets, corporate assets like equities, as well as real estate. Rents, with the big giant software companies moving out of California, they're still moving to fairly high cost area places. I would not try to follow these big trends too much, because what you're seeing is it's not really that big. You're also seeing that by the time you're hearing about it, all the real estate people have done something about it. You're too late. So they're moving to Austin. They're moving to parts of Texas that are pretty appreciated already. I would not buy in those places as well. Maybe in Kansas City or other places that don't have as hot of a topic. I am generally not a fan of chasing trends. That's not what I do with real estate, although I do like to chase long-term trends. And there's lots of people like Travis here who has a lot of good perspective on California real estate.
Abdul has asked another question here. What does the real estate market and stocks look like in the year 2021, in your opinion?
I see. I can't speak for stocks because I don't even know what the market looks like right now. It's one of I know that I have a lot of stocks. I know what Apple stock is, barely. But I generally think of it as a set and forget it kind of thing for myself. Real estate markets in 2020 has stagnated, meaning that transactions have not happened. In 2021, transactions will happen more at a faster clip as New York opens up in Q3, Q4. I do think there's going to be a big rebound but I do think that there will be a short-term spike, a decrease in rents, mostly across single family, which means that for folks who've lost their jobs, who are in forbearance, when they have to start paying their mortgage back, they will have to sell. And when a lot of people sell their houses, that drives on prices. That's another negative of single family houses. It's very affected by the market, very affected by buying, selling, and sales comparable. Commercial properties do not have necessarily the same tie and the same correlation, although it's slight correlation.
What's your take on moving out of California? Do you think it's a bad move? A good move?
I moved out of the Bay Area recently. I bought this 1.5 acre house in San Diego for something that would get a little townhouse in Mountain View. Yeah, it's nice. I still pay California taxes. I have considered moving to Texas. If I have family here and the food's pretty good, the quality of life, I don't plan to pay federal taxes. I probably plan to pay California taxes, unfortunately. Cost of living here. I think it's an interesting move. I would probably consider it if I didn't have too many attachments here. So I wanted to talk a little bit about residential over commercial, and let's put some definition here. When I say commercial, I don't necessarily just mean office buildings, retail. I also mean like a fiveplex. A fiveplex in a multifamily traditional sense is classified as commercial because that's what banks classify it as. Residentials are very accessible. It's familiar. Everybody knows somebody who probably has a house. When you're familiar with something, you feel like you know it. It's probably not necessarily a great thing, but you probably lived in one, so you kind of know what it is. That's not necessarily real estate investing. That's real estate. It leverages your finance. When you get a residential loan, they figure out how much income you have. They don't figure out how much income this house can create. They figure out how much income you have, and it does not scale. You could probably only get 10 mortgages. I have been capped at that time, and property management. If you're worth anything as a property manager, you're going to want to manage a 100-unit building versus a 1-unit building, a 3-unit building. So you're really not going to get, you're going to get hobbyists or unprofessionals in that level. Commercial, which includes residential, it's all over the map. Obviously, hotels have been suffering recently, some retail as well. Industrial data centers have been very hot. Cold storage might be a very hot asset, as we need more long-term vaccine storage for at least 7 to 10 years. Financing actually can be a lot easier with commercial, and you can control more your valuation. And thematically, what I'm talking about is control and predictability. Cash flow to me is control and predictability. I can control my valuation because I can reliably, predictably control the NOI. If I raise rents, I could probably have a decrease in vacancies, but there's probably an optimal point where it makes the NOI higher. If I reduce my expense by cutting costs or having lower variable costs with a bigger property, then my NOI goes up, net operating income. That dictates the valuation of your property. Residential is dictated by how much your neighbor sells for. If you rent your house for $3,000, but your neighbor rents for $2,000, and the same house, and he sold for $1 million, your house is worth $1 million. Doesn't matter if you make 50% more rent. In commercial, that's not the case. It almost always matters just what you're making in rent and NOI.
So we got a question from Mary here. She asked, any recommendations regarding opportunity zone funds, I'm guessing, investing in real estate? Also asked tax saving strategy, any particular funds you recommend?
I have a fund. I've been literally talking to folks for the last 2 days nonstop. You should see my calendar. It's like telling them all about QSEFs and tax treatments and investing. There's quite a bit of funds you can find. I have one as well. if you want, you can reach out to me. I'm happy to recommend. I would probably say most funds are, try to fit your criteria of where you want to invest, what you want to invest in. And then if you've sold stock more than 180 days ago, then you have until tomorrow to invest, which is why I'm very busy. Meaning that if you sold stocks in December 2019, you still have time to invest in OZ because of the IRS Section 120. But as soon as January 1st hits, you will not be able to invest. You only have 180 days. So if your 180 window expires by January 1st, you cannot invest. I don't have any slides on OZs, even though I've been talking about OZs as well. I felt like I guess people are still interested in OZs. Okay. So what you need to obtain a residential loan? You need a lot of things. And trust me, as somebody who's probably obtained, including refinances, probably 30 residential loans. It's a pain in the ass every time. And I always am frustrated by how often they ask, what is an RSU schedule? What is this and that? How do you explain this? What is this? I'm like, is this your first time? When you work in commercial loans, this is almost always what I've needed to give. Maybe I need to give something a little bit more, but in general, it's pretty easy because they don't care necessarily about you. They do care about you, of course, but they care about the property. If the property can pay a mortgage, that's all they care about. If they can't pay the mortgage, then they probably won't give you the loan. For a house, for a residential, they don't really care if the property can pay the mortgage. They care that you can pay the mortgage. In fact, most times it can't pay the mortgage by itself because it doesn't cash flow well. So let's talk about cap rates. So I'm going a little tangentially. Cap rate essentially is NOI divided by purchase price, net operating income divided by purchase price. The higher the cap rate, the more the yield. Think of it as a PE ratio. 4% cap rate means that on $1 million purchase price property, it generates $40,000 in net operating income. Net operating income is inclusive of taxes, expenses, potential vacancies, repairs and maintenance, capital expenditures, but it's not inclusive of debt. So just FYI, because debt can be different for everybody. NOI should be innate in its nature, meaning that it doesn't change if you buy it or I buy it. Although hopefully I can optimize it better. So the higher the cap rate, the more the yield, the lower the cap rate, the lower the yield. And if you're living in San Francisco, I'm sorry, you're not living in very high cap rate areas. And even, so for people thinking about buying in Austin is pretty low in cap rate too. The returns aren't there. If you've been thinking about buying Austin, you're 6 years too late, guys. If you think about buying San Francisco, you're 14 years too late. So maybe multifamily in general is like 3 years too late. I don't know. It's always deals to be had, but it's just harder. I like to buy in tier 3 cities, tier 2 cities. I like to buy where not a lot of capital is chasing, right? If you go in crowded markets, just like anything else in equities, you will be competing, and competition drives up prices, and driving up prices drives down yields. Yields is everything, at least for me, in terms of cash flow. What does it mean to have these different cap rates? It means you're losing money or breaking even, or you're making a significant amount of cash flow. And that's based on leverage and on cheap leverage.
We got a quick question here. So how about Central Valley, California? And also, where does the data come from, the chart on the cap rate?
CRB, go to crbe.com. Let's just go type cap rate map. CRB is the first thing. Central Valley is better than the Bay Area. It's not amazing. I think I would probably care more about the asset class. If you can find multifamily in Central Valley, that has 6% cap rate with some value add, that could work. Again, it's not going to scale. And also consider California as a high regulatory state. It's just not favorable to be a landlord in California. If you're buying a single family house portfolio, you're buying for essentially what you're doing with single family houses is that it has a lot more price volatility. If the overall market goes up, it generally goes up a lot faster. If it goes up a lot faster and you're leveraged and you have 20% down on a portfolio, then every 1% that goes up, you're getting a 4 times return or 5 times. I forgot what the math is, but you're getting a leveraged return. Same thing goes down when it goes down. I mean, if you're essentially buying a 100-unit multifamily apartment building, it can be comparable to buying 100 single-family houses. You can buy a portfolio, and you can get a commercial loan for it. There are many roofs, many walls, and more parcels. The buying options and selling options are potentially different limitations. So I have not done that myself. I have packaged it up and sold my property as single family house portfolios. I think it sells easier and faster and better at a individual unit. But of course, hedge funds buy big blocks and 100 single family houses all the time. It's just not an asset class I am that deep into. So cap rates, yeah, buy higher cap rates if you can, and that means you're probably not gonna buy in California. Price to rent ratios is something that you should consider as well. What that means is, with a higher price to rent ratio, it makes so much sense to rent. When I was buying this house for several $1 million, I was considering, man, I should just rent. I could rent something for the same amount of money I would have paid in mortgage and got then a house valued at 2x. Because there's a certain like curve, and I may should illustrate this sometime. When you buy a house that generates this much rent or income, it's this. When you buy a house that generates 5 times much rent or income, a house, I'm talking about a house, it exponentially grows in value because those houses you can't rent for too much more. It's usually a floor in rents. Price to rent ratio is a very critical thing. If you're living in San Francisco and you're considering buying a house because you think it's going to generate well dunked, buy a house because you're nesting, buy a house because it's an emotional decision, buy a house because it's a luxury decision, not because it's a economic financial decision. I have lost money on every house I bought because it has been an emotional decision because I want to live nicely, and every nice house is a shitty investment. Now, that doesn't mean I haven't made money on it. I just said I could have made a lot more money if I invested it. And so a lot of people do choose, if they're living in these high price rent ratios places, to rent, and it makes a lot of financial decisions to do so because the opportunity cost of your capital deployed somewhere else and the SOT limitations of $10,000 means that you can't even deduct the entire mortgage anymore. So that's gone. But whether that would be reversed or not, I don't think so in the next year or two. For commercial loans, mortgages can be deducted, interest can be deducted uncapped. There's no cap on that. So there's a lot of benefits of renting and then arbitraging and using that money to eventually be a landlord somewhere else. Essentially, ultimately what you're trying to do when you're buying a house is some kind of permanency or some kind of like nesting. But if you think about buying a house because you want to not have a mortgage or a payment, consider it as a portfolio. Rent a place, use the money that you bought a house to buy or invest in a real estate syndication like mine, or property somewhere else, non-California, and make net positive income that essentially would pay for your mortgage or your rent in this case, and have a lot left over.
So I just answered this question, but maybe read it out for everyone. Can a home used as home office be purchased as commercial? Or when you say commercial means retail space or shop space?
So the definition of commercial is any property um, that's not single family, that's not a 1, 2, 3, 4 units. Everything else counts. A 50-unit apartment building counts. 20-unit apartment building counts. Um, what you're referring to, Mary, is probably rental properties, right? So a rental property can be, I think commercial and residential, that's more for like NOI drives the valuation, and the loans are different. But rental properties, there's also a difference between rental properties and non-rental properties. Your house could be a rental property by house hacking. I would advise saying that's not necessarily the best optimal use of your capital. And I would always try to understand the math every time you use your capital to do anything. Even building an ADU, which is very popular, might sound good, but if you did the math, I would imagine it wouldn't turn out as well as if you looked at some syndications like ours. So I want to go into then cash flow and why I love cash flow. And it's not to say that appreciation doesn't work. And I think for folks who bought in the Bay Area in the past 10 years, made good amount of money. I would argue that if you invested that money into Apple stock, you probably made more. So it's really all opportunity costs. Cash flow for me is predictability. I have lived with unpredictability a lot in the past, day trading and buying stocks. And I have my stocks for speculation. I have my stocks for appreciation. In fact, if I was going to buy on the basis of Austin growing up and becoming a better place because I believe in these businesses, why not? Why don't I just buy these business stocks? Why don't I just buy Tesla stock? Why don't I just buy all the stocks in the Bay Area? Because that's going to be much more correlated to house prices and liquid. Well, you can't leverage it though. Cash flow is more predictable. It's less risky during downturn because if you're betting on appreciation and it doesn't happen, and you still have to pay for the mortgage, and your cash flow of your own income goes down, then you're in personal financial risk. While cash flow investing means that the property is paying for the mortgage, and if you lose a percentage of vacancy, it should still have a healthy buffer. Now, cash flow for most people in California means that you're probably not in the backyard, not it's not where you live. While appreciation, it's usually where you live, so that's probably why people are investing where they live. I understand that. Is it perfectly reasonable thing to do to invest where you live? It feels safe, feels secure. You can go look at it. I mean, to the extent that you might have some innate advantage of looking at it versus not looking at it. I don't know. It seems kind of weird. You don't like meet Elon Musk, do you guys? And do you have to meet Elon Musk to invest in Tesla? If you met him, you probably would even be a little more hesitant. Travis probably has some opinion on that. Depreciation and deferrals help with cash flow, and I'll talk about that in a little bit. But depreciation benefits is one of the major reasons why I love real estate. Depreciation benefits means that I get a lot of my earnings from rents, from cash flow, tax-free or tax deferred, almost as good. And sometimes tax-free if you do it right. So go ahead.
Quick question here. So can I 1031 a single residential condo to commercial multifamily property?
Yes, if it's a rental producing income producing property and you're renting it, you can do that. Here's some advice, guys. If your house lost money and you sell it, you can't take that as capital gains losses, which would be beneficial. But if you rent it for maybe a year and then you sell it at a loss, you can take it as capital gains loss. If you sell your house as a personal income property, there's Section 120 or something that allows you to take $250,000 single or $500,000 married of free capital gains. So 1031 exchange makes sense for things that it's only done for rental producing, income producing properties. So you can convert a condo into income producing property or a personal property depending on when you live there. You can also just rent it to yourself by owning it through an LLC. And yeah, don't tell anybody I told you that. It happens all the time. Any other questions?
Isn't depreciation recaptured when selling the real estate though?
Yes, I'll talk about that in a little bit. Depreciation, I love it. And thanks for bringing that up, Mary. I think that's something that depreciation recapture is something that people don't think about, but it happens regardless if you take advantage of depreciation or not. The government will assume that you took advantage of depreciation. If you don't take advantage of it, you still owe the depreciation recapture. So take advantage of it. I would assume that you're automatically taking advantage of it. So let's talk about depreciation as an example of what it means. Depreciation means that if you're buying a property for 12% cash flow, and I did the math on this one, you're essentially getting probably enough losses, paper losses, right? Think of the real estate as a business. You have profits, and you have revenue, and you have a lot of expenses. And the net is net profits. You get taxed on net profits. Cash flow is revenue. Rent is revenue. Depreciation, which is a paper loss, is an expense. In some cases, if you invest for cash flow, if you invest right, your net losses will match your net gains, or your losses will match your gains, but thereby giving you your $12,000 in this case, or 12% tax-free. Now, during this whole time, you save $22,000 of taxes saved if you were paying at a marginal tax rate of 37%. I think that's the math or something like that. When you get recaptured in the future, you pay at a max of 25%. So you're transforming your tax rate from ordinary income, passive ordinary income, to long-term capital gains or depreciation recapture rate of 25%. So you're reducing the tax rate and you're deferring. So let's talk about the conversion. So you're changing 37% to 25%. Pretty good. Now, when you defer those taxes, hopefully you're investing that cash flow. And if you can invest it again into 12%, you're compounding and reinvesting it. So not only are you you're paying less in the future, but you've also had the opportunity or you've given up the opportunity cost to invest it, right? Any money that you had to pay in taxes now, if you get paid in the future, hopefully you're investing it and you're earning more. And so by the time you owe that money, and imagine you owe the same amount of money, you have more money from that compounding and investment. But in this case, you're owing less money in the future. Not a less rate, is a less money overall too. So that operating cost is really a powerful thing. You should understand operating costs. And that's a big part of real estate investing and deferrals. Another part of it is that money that you owe in the future will be eroded by inflation. This is also why I love long-term debt. If I borrow $10 million of debt and I was interest only for 20 years, that's amazing. I would love that. I would have to pay $10 million of debt in 20 years. I would imagine that $10 million of debt or $10 million of dollar value cash wouldn't be worth that much. Probably worth like 3 Bitcoin. I don't think so. But yeah, the value of dollar erode. Yeah, you probably make more money. Inflation at 2%, which is very conservative. Probably more close to 3, will make your money go longer, more in the future. So lots of benefits of deferrals. How do you get more depreciation? When you buy properties, if you buy $1 million property and the land value was 20%, you can take 80% of that $1 million as depreciation over 27.5 years. If you leverage it, you now can only have to put 20% and then get an outsized amount of depreciation because the bank or Leverage does not share in depreciation. Only you get the full depreciation amount. The lower the leverage, the less depreciation. If you're buying all cash, you're doing it wrong. If you're buying, let me rephrase that. If you're buying all cash and not refinancing in 6 months, like I have in the past, then you're doing it wrong. Because you could have some all cash buys, but you should definitely leverage at some point. Because essentially, you're trying to optimize your capital. If you can borrow at 4%, do it. So lower leverage gets you less depreciation benefits. Higher land value gets less depreciation benefits. So if you're buying in San Francisco or California, where land value is high, you will get less depreciation benefits. That means that you should buy in low land value areas. In Kansas City, I buy typically at as high of a leverage as possible and as low a land value as possible. And how to get high leverage? If you're buying for appreciation, you're going to get leverage up to what you can afford from your personal income. If you're buying for cash flow and very high cash flow, where DSCR's, debt service coverage ratio, is above 1.5 to 2, you can get a very high leverage, up to potentially 80%, where we've gotten a lot of our properties. That means that high cash flow has so many other advantages, but having high cash flow means that you have a huge buffer to pay the mortgage. Paying the mortgage with a huge buffer means that the bank is more willing to give you more money to buy that property. Having higher leverage means that you take a bigger chunk of that depreciation benefit. So leverage depreciation, get more leverage when you buy at lower land value, and now your $12,000 a year in earnings is negated by $17,000 a year. And if you're a real estate professional, take that extra 5 and use it against your W-2 income, or just do bonus depreciation and take it against all your income. Don't pay any taxes at all. Federally, California takes it no matter what.
So
hard to get rid of it.
Question here: can bonus depreciation and cost segregation be done on single-family rental homes? If yes, do we need a specialist to do so, or CPAs?
You probably need a specialist. I haven't done it without a specialist. Yes, you can. You can cost seg anything that is an income producing property. You can cost seg something that you bought 20 years ago, since 1986. I'm not sure. I'm not gonna do the math now. So yeah, 24 years ago. That means that if you bought something 3 years ago, 4 or 5 years ago, and the purchase price was more than $1 million or $500,000, you can do a cost seg study and take 20% of its non-land value and take it as a bonus depreciation, and then just take it that year that you did it. Some CPAs would charge you $1,500 to do it. They use software. Some engineering firms would charge you $5,500. For single family, it probably cost $3,000 to $4,000. If you're buying a big $3 million house in the Bay Area, potentially look into buying it in LLC, renting it to yourself, taking cost seg, depreciating the whole thing, and writing off the interest uncapped, and then using the rent as an expense. So consider it. lots of things you could do, especially creative. If you own your own business, lots of creativity. By the way, owning real estate is essentially like owning a business. This is why you can take so many expenses. I could have this Zoom call as a expense, which, by the way, I am. This office is an expense. That painting is an expense. So these are all things that you could do: pay your kids, etc. Shift income, and of course, if the depreciation recapture that Mary talked about happens, that means you're doing it wrong. That means you haven't tendered an exchange or kept deferring it. If you tender exchange a property, you defer the depreciation recapture because it's cost of capital gains. You defer the capital gains, and your cost basis that you've taken down through depreciation gets transferred to the new property. And the new property also generates more depreciation. Imagine that. You could have bought something for $200,000 cost basis, and then bought something again for $400,000 and bought something again for $1 million. And you kept getting more depreciation and never paying taxes on cash flow. Now, if you're buying for appreciation, you're not getting cash flow. So you're just getting the capital and it's stuck in that property. If you get cash flow, you can compound it and invest it everywhere else and keep doing it snowballing. Opportunity zones, by the way, are also a way to essentially get rid of this depreciation recapture. When you hold an opportunity zone for 10 years, depreciation recapture does not happen because all future capital gains gets eliminated, meaning that if you buy property for $1 million, it sells for $2, that $1 million profit gets eliminated, and that bonus depreciation and straight line depreciation, which would probably amount to $300,000 worth of gain benefit, would be eliminated. So do opportunity zones. I have one.
What if, okay, we got a question here. So what if the property needs a rental manager? Do you find one yourself?
Definitely consider your time when investing, because I think people don't often consider the time. Don't get yourself a $12 an hour job. Do I find more myself? I would say if I was, it depends on what kind of asset you're talking about. I would assume you're talking about buying, triplex or quadplex with single family house. Yes, I mean, you would have to find one yourself. If I buy large 100 plus unit apartment buildings, and we have big companies that do these property management, and they're professionals and they do it very well at low variable costs. Should I explain opportunity zones?
Yeah, so Ram had a question here. Could you explain what opportunity zones are?
It's like the one deck where I took out the opportunity zone slides. In short, it allows you to sell stocks and defer those capital gains. It allows you to defer any capital gains from sale of business, real estate, stocks, collectibles, etc., short term and long term. When you invest $100,000 of capital gains, your X percentage of taxes that you have paid does not have to get paid right away. It gets deferred into the end of 2026, so 6 years, paid in 2027, and reduced by 10%. And then all future capital gains gets eliminated if you hold for 10 years. Operating zones are essentially zones, special economic zones that local governments classify through the Jobs and Act, or the Trump tax cut in 2017. And it's a great way to not pay taxes. Although if you have sold stocks in February, you typically would have 180 days to invest. But if you invest before tomorrow or by tomorrow, you can defer those gains. I think I will probably have to take a lot more calls.
And also I want to ask as well, opportunity zones are a relatively new thing, considering that it's end of 2017. So it's really only been 3 years.
Yeah, a lot of people still figuring it out. A lot of people, it's opportunity zones don't have to be real estate, by the way. But real estate is the best way to invest. So that's why most opportunity zones are real estate.
Interesting.
Opportunity zone funds are probably the easiest way to invest, because you're probably not going to buy an opportunity zone building and then develop 100% property improvements, which helps you classify as opportunity zone. If you invest in rental property, cash flow, 1031 exchange, invest in cash flow, 1031 exchange, if you do all that, your cost basis by the time you've done it 4 or 5 times is 0. And you owe so much taxes if you ever sold without 1031 exchanging. If you pass away, your heirs get it adjusted to fair market value, and you do not pay any taxes. No one's ever stuck in the back. Go ahead.
So, question here. To my understanding, opportunity zones, or OZs, it helps government to build up underdeveloped area or low income areas. Assume an OZ for affordable housing. Have you seen it cash flowing? Isn't these properties invites high risk tenant, rather higher rent defaults? Is the principles protected in OZs?
I'm going to unpack that question. First of all, no. the thesis of opportunity zones, and it's a bipartisan effort introduced by Senator Cory Booker and another Republican, so Democrat and Republican, was to help underserved areas. Now, these areas are defined by the local government. San Jose has large swaths of areas that are worth a lot of money that aren't impoverished at all, that are classified opportunity zones, where they're building $100 million mega luxury apartment buildings. Those are opportunity zones. I did not invest in those because I don't like fancy buildings. I love affordable housing. I love low income places. I think the thesis here is more work means more reward. If you're investing in a company like ours, we're doing the work for you. So we have the scaling benefits to essentially optimize and get the returns that would be possible in these B, C class areas. A class areas are trophy assets that people buy for capital preservation, and because these are probably the most abundant areas to buy.
Okay, we got lots of questions. If you got time to answer these real quick. How do you find a rental manager near where you're buying the property? That one's relatively easy.
I would imagine you're referring to like buying a house and then renting it out. I would say I'm not an expert in that because I don't do that anymore, and I also would not advise you to do that. So I'm sorry. I'm sure there's lots of new prop tech that allows you to do that too. There's a bunch of new like startups developed just for that purpose.
Can certain REIT purchases be classified as opportunity zones?
REITs isn't a direct investment in real estate, which means that you don't get the same tax advantages. So REIT purchase, if they buy something in OZ, it doesn't matter. It does not affect you. Does not help you. There's no depreciation benefits as well. REITs essentially passing 95% of renter income to you. It only gives rent, and then it has a market valuation based on is buy and sell demand ratio.
Okay, one more here and let's keep it going. So would investing in opportunity zones for a person interested in purchasing one property? Is opportunity zones ideal for big companies or for people like me interested in purchasing duplexes or triplexes?
It's definitely, so I don't think it's a good idea to buy duplex and triplex in general. So I probably would not advise you do that. You can do that as an opportunity zone. That's definitely possible. To qualify an opportunity zone, it has to be in an opportunity zone. It has to be an original use case. This is one way to do it, meaning that it has to be unoccupied and then you just build it and you buy it before certificate of occupancy. Or the most common way to do it, essentially put 100% capital improvements into it, which means that it's almost always a development. So most people aren't going to buy land and develop it, or buy an existing parcel, tear it, raise the place, and then develop something at 100% of the amount they purchase it, the non-land value. So most people invest in opportunity zones through funds like Tozy Capital, where you essentially co-invest with 50 to 100 other investors, putting $50 to $100,000 into the fund, where we collectively buy a 15 to $20 million asset and have the scale benefits, the managerial expertise to optimize it, and then to pass along the direct benefits to you. That's essentially what syndications is what real estate co-investing is. You're a shareholder of an LLC, most likely, that owns directly the real estate. You are a partial fractional owner of the real estate.
So we do have questions, but I know you have we sort of have a hard stop at 7. Eng, are you
Oh, we do? Okay.
Well, the holiday party.
It's 7:30.
Oh, it's 7:30. Okay, we're good. Okay, so
I will speed up because I do have a lot of slides.
Okay. Let's let Eng speed up a little bit, guys, and we'll get to the questions at the end. I do apologize.
Okay. I'm going to get a little diversion here because, and I realized that I probably should have like covered some more basics because I'm like going through like deep end now. Capital stack. Let's talk about capital stack. Favorite topic. Debt is the highest priority on the capital stack. It's also the safest. That's why you can get debt for 3-4%. Debt does not want to be 100% of the capital stack. If it's a safer asset, it will be a bigger portion of the capital stack. I mean, you get higher leverage. You always want debt because debt is cheap. If you can predictably rely on the growth or the income of the cash flow. Remember, a cash flowing asset could lose a ton of value, but you don't care as long as you pay the mortgage. Above that is pref equity. That's second in risks and second in liability. So I mentioned pref equity because I love investing in pref equity. When you invest in a mid-tier capital stack, you get predictable high yield cash flow, very secure, safe, predictable, that allows you to essentially get some of the similar benefits of debt, but all the benefits of equity. So you get payment priority, you get downside protection, you get tax benefits, and predictable income. So imagine this: if a property made 10%, made 5% a year, which would, to be honest, suck for me. But the pref equity was 50% of the capital of the equity stack. That means that it gets the full 10% it would get because the property made 5%. That's enough to give half the capital 10%. The other half gets 0. So you're essentially getting the least volatile aspect of predictable cash flow. And again, I talk about cash flow because I want you guys to focus on that. Focus on double-digit cash flow. Try to get 10%. And if you can get 10%, you now make decisions very different in life. You think like, oh man, that car payment, the car loan is 5.5%. Seems high, but if I can invest it in 10%, well, of course I'll do that. Same for mortgages and whatnot. Senior living for cash flow is also another asset class I love. And I mentioned senior living because, first of all, I do senior living, but also over time, I've migrated to higher cash flow areas and assets. I migrated from single family to large multifamily. I migrated from California to Kansas City and Florida. I migrate to places that have cash flow. You continually have to move on to places as those places become saturated, and saturation means lower yields. So with senior living, why I love investing for senior living is because it's real estate with all the benefits of real estate, but an operating business with some of the risks, but a lot of the returns of it, and has usually 80% higher NOI. There's a ton of great trends, tailwinds for senior living, lots of supply, demand, shortages over the next 20 years, aging population, and high local demand allows you to easily lease up and charge $4,000 to $5,000 of rent relative to places that charge maybe $1,000 rent. So I also build assisted living. That's what the Qualified Option Fund we have is. We have a few more coming up. We have more and more. Talk to me after. You can buy an A-class building and get really high income potential. You can get very longer stays, and they're non-working tenants, so they're not dependent on income or jobs. They depend on the retirement funds, and they have healthy retirement funds because they have annuities and they have 2 to 3 years left to live, and so the returns are much higher. I'll plug in this one investment that I have, and I want to talk about this investment because it fits the bill for what I've been talking about. You can get something for 12%. You get depreciation, which means that your 12% is tax-free. In this case, if you invest $100,000, you get an average of 12% every year. In the first year, you get $500 a month. In the second year, $1,000 a month. In third year, you get $1,500 a month. And then at the end of 3 years, you get your $100,000 back. And all the while, that cash flow is tax-free. And it's 3 years. It's newly developed senior living facility in Kansas City. And let's talk about why that tax-free is important, and also why 12% is important, or why I love a big number on compounded interest. 6%, which is what on average the S&P has grown. This is a long tail approach, of course, not recently. On $100,000 invested will yield you $179,000. 12% invest compounded on that same 100,000 will yield you 310,000. And this is a little bit exaggerated, but if you were essentially getting that 12% tax advantage, meaning tax-free, that would be probably equivalent to a 17% compounded, and you would get a lot more. Now, if you started investing now in these syndications or any in real estate, and you could get 12%, and you invested $100,000 a year, and starting with this year, for 10 years, your future balance, future capital invested would be around $2.2 million. That means $23,000 in monthly tax-free income. Not everyone has $100,000 a year to invest, but if you could invest in real estate tax-free, essentially getting a 37% discount on your investment and get a high compounded rate or high cumulative rate of return, potentially 12%, like what we do. So don't accept 6%. Don't accept low single digits, which is what you're getting in California. You can find financial freedom pretty quickly. And if you have more, it can come even quicker. So I have invested not $100,000 every year. I have not invested $100 when I first started. I was in Peace Corps making $200 a month. I have had some good fortune and some bad fortune, but I have continually invested and reinvested my money in real estate and my tax-free money in real estate. And this last year I've made more passive income, nearly $500,000 passive income, that's tax-free, to my Apple income, which feels very good. Just had a baby too. So that's me. A little bit over time. Apologize for that. Let me know if you have any questions.
All right. So we do got some questions here. Does preferred equity get capital appreciation?
No. So there is a pro and a con of preferred equity. The biggest pro is preference and is safety insurance. Ultimately, if you're wanting appreciation and high yield, I would probably look for stocks, to be honest. I think of this as a diversified income fund. Think of your portfolio. Typically, investment advisors will advise you to have a good portion of your portfolio in predictable asset classes. Bonds yield very little. These preferred equity options with 10, 12% returns is very predictable and very secure, and yields very healthy. So think of it as a portfolio investment. Consider investing in both in some cases, both the common and the preferred equity.
Where in Florida do you like?
I like a lot of places in Florida. I think people get fixated a lot on specific location. I think there's lots of news story you can find and feel, but if you look at the overall underlying data, there's at least 12 metro areas in Florida, inclusive of Orlando, Jacksonville, Tampa, that have healthy population growth, job growth, and crime decrease. I love Kansas City because it's the same thing. I think Florida is a little bit more pricey, but for senior living, that's a pretty good market to build and develop into. So that's the fund that we have is in Jacksonville. We're building something near Orlando, and buying something near Cape Coral in southwest Florida.
So we had some questions here. Well, Romar did ask, "Hey, Eng, how can I reach you, Eng? I want to learn more about investing in your company." So I said, I know you get a lot of emails, so go ahead and feel free to email me as well, and I'll try my best to schedule time with Eng for you guys. Let's see, a question here. So is senior living lease occupancy doesn't hit the target, will you be able to pay preferred equity?
That's the great thing about preferred equity. It's oftentimes not necessarily correlated to a high optimal leasing rate. You really just have to pay debt and then expenses, and then you pay equity for equity. Oftentimes you don't even have to pay any fees, management fees, salaries, all like subservient to it. So in most cases, no, you don't even have to hit a specific target, and you have to have a very low bar, so you feel much safer. I love providing pref equity positions to investors because it's safe, it's predictable, and for me, I feel I sleep better at night when I can meet people's expectations safely, when I'm not living on the edge of one or two tenants moving in and out. If I one or two tenants moving in and out, if that variance happens, that affects the sponsor returns, not the pref equity returns. That feels better for investors. Now, that's not to say that there's not any cons to it, but you think of it as portfolio theory. Consider upside investments and high yield investments. Whatever you do, try to get at least 10% returns and find that's sort of my cost of capital. Consider your cost of capital very valuable. Consider your time very valuable, and you make more optimal decisions.
Okay, so this one's for Tina Ray Fujihara. Tina, I know you had a question, so if you want to ask, feel free to unmute and ask. And if you're not there, or if you can't hear us, I just allowed you to speak, so feel free to speak. Okay, if not, then I have a question here. Does the tax treatment only apply to OZ investments?
There are two tax treatments I've been referring to, and the one that I mostly been referring to is on just real estate. That does not have to be an OZ. Tax-free investing in real estate means that you get a paper loss of depreciation and write off your actual gains of cash flow, and that is agnostic whether it's an OZ or not. An OZ within the real estate is supercharged, tax favorable, but I mostly do non-OZs because OZs have to be 10 years as well. So probably a little bit longer than most people would like. I'm a long-term investor, but I also have short-term investments, 3-year investments like Grand Royale is 3 years.
Okay, I think that's all the questions we have, guys. We are over time by 11 minutes, but I just want to say, Eng, thank you so much for tonight for the awesome session. Happy holidays, happy New Year to everyone. Some of our funds deals are actually closing tomorrow. So if anyone has like, I guess, capital gains or any preferences on investing in 2020 before 2021, feel free to reach out to myself or Eng tonight. But I hope tonight everyone really enjoyed the content and had a good time. So let's see, we got some feedback. Awesome information. Thank you very much. Do you charge if giving consultation my situation in my taxes investing real estate? I mean, we'd love to talk, but I don't want to push everyone's time anymore here. So I just want to say thank you guys. Thank you tonight, and we'll go from there.
Happy New Year's, guys. And I look forward to talking to you guys if you guys want. I will be sending a follow-up email with the recording. And of course, reach out to Kay or myself.
Okay, sounds good. Happy New Year, guys. I'm logging off.